What's going on, beautiful people? It's Joe, aka the Nomad Investor, where dividends freedom anywhere is the goal. And today we are back with another portfolio update. If you are new here, it would mean the world to me if you could subscribe. It would not only help out with the algorithm, but it would help keep me motivated to continue making videos like this. Now, with that being said, let's hop into things. So we are at 622 subscribers currently and 21 videos on the channel. I am filming the 22nd video. And I'm really excited to share. This is the 20th update. So let's get into it. As always, the videos on this channel are for informational, entertainment, and educational purposes only. I am not a financial professional or advisor, and nothing here should be taken as financial, investment, or tax advice. Investing always carries risk, and those seeking financial advice should seek out a registered professional. For those of you who are old here, you guys can skip past this part, even though I have a few couple tweaks that I've made recently. But if you are new here, this is the game plan and goal for growing a small portfolio from $0 to $1,000 per month in dividend income. So I have two sources of income currently. I have remote work income, which is pretty stable, and then I have business income, which does fluctuate up and down. So I've committed to contributing around $300 minimum to up to $1,000 plus per month into my Robinhood taxable brokerage. And I'm treating this brokerage like a business, aiming for 30% plus high yield. Now, I plan to achieve that by investing into high yield income ETFs, such as, but not limited to, WPAY, HOOW, QDTE, XDTE, XPay, BLOX, and etc. And previously, I did have set a max of 3 positions, but I recently changed that to 5 positions. So I'm going to be alternating between anchors and satellite ETFs. This is following the core satellite investing strategy. I learned this from a guy by the name of Eugen Vasquez here on YouTube, but this is a tried and true investing approach. Investing strategy has been out for quite some time. I'm going to be reinvesting the weekly dividends or monthly dividends, depending on the fund I'm invested into. But I'm either going to do DRIP, which is automatic reinvestment, or I'm going to stack the dividends. So I'm going to collect and save the dividends to purchase at a later time when the market is down. And DRIP plus always compounding is the portfolio growth strategy as a whole. So basically, I'm going to be rinse and repeating this until my account hits $1,000 a month in dividend income. Now, disclaimer again, none of this is financial advice, and this is strictly for entertainment purposes only. Now, hopping really quickly into this, these are my dividend income milestones while I'm growing my small portfolio. For those of you who know, this is just so I can celebrate the small wins leading up to the bigger goal along the way. But I'm happy to say we have officially, as of today, smashed that second goal. Officially, we passed that $200 a month milestone. So round of applause, round of applause. I know. I actually got feedback from a viewer and they told me that I should look into changing the colors of these milestones once they're achieved. So I did that, and thank you so much. I pretty much said this in the last couple videos that I've done, but I'm looking at possibly implementing a new strategy. Basically, I'm looking to diversify a bit and hold some different positions that are more focused on some growth. Also, I'm thinking about what if there was a bear market. And a lot of people in this high yield ETF space, they are euphoric. And I've been there, especially with like other markets, like the crypto market, for instance. It's very important that we learn what we're going to do or have a plan for what we're going to do should a bear market come. Yes, we're in a bull market technically right now. Yes, we've had a few pullbacks here and there, but we're still moving up in a bullish pattern. But what if? Just what if? What are we going to do? So I'm contemplating some different plans. A lot of you have shared some really good strategies. I haven't set myself concrete on one, but I am considering it. So if you have any other suggestions or feedback, comment it down below, and I'd love to review it. Now, moving on to the portfolio, we are currently sitting at $4,616.30. We are down $13.37 for the pre-market, which is 0.29%. So basically 0.3% down, which is okay. I mean, today dividends are being paid out. There's also, I think, the ex-dividend date for WPAY or something of that nature. Maybe that is contributing to this. I'm not really sure. But as you can see, there are some changes. So not only did my portfolio amount increase in value, but also my buying power did as well. We're at $1,639.62. We are at a 51.06% buffer, which is also $2,363.36 above my margin buffer. And the reason for that is I just decided to contribute $200 last night to pay off some of this margin, as I'm going to be kind of working towards trickling this down and paying completely off. But that is why the buying power has increased. So first things first, WPAY. WPAY is currently sitting at $53.88 for a share. And our market value for that is $3,828.68. We are up $50.50 or 1.34%. And my average cost per share is $53.17 a share. We have 71 shares, and this has a portfolio diversity of 50%. And as you can see down here, we have a maintenance ratio of 30%. Here on HOOW, we have a price of $75.67 a share. Our total market value is $2,346.20. We are up a whopping $230.81, which is also 10.91%. And our average cost is $68.23 a share. We have 31 shares, and this is a portfolio diversity of 30.67%. So this is increasing. This increased by like 1% roughly due to just how much it's doing good in total return. And then we have a 30% maintenance ratio on this as well. Last but definitely not least, we have NVDW. I would say this one isn't performing as great as I expected, but it's still doing well. We're sitting at $47.61 per share. And our market value is $1,475.91. We're up $67.62, which is also 4.80%. And our average cost is $45.43 a share. We have 31 shares, and our portfolio diversity is 19.29%. This is also at a 30% maintenance ratio. So this is all looking good. Now, hopping over real quick to the investing journal. So for those of you who don't know, I've been contributing towards this investing journal since the beginning. I did start this account back in August 19th, 2025. We started with $678.67 at the time. I was invested into ULTI, XDTE, and YBTC. Anyways, this is where we are at today. So I did this earlier a little bit before I filmed this video, and we were sitting at $4,624.82. Ignore this number. This is not up to date. But these are my monthly contributions, which have changed since my last update, which is $2,281. And that's because it went up by $200 because I paid off that margin. Yeah, these are the positions I already covered. You can ignore these values here. And then as you can see, our margin decreased since the last update, which was at 3,234. Well, now it's 3,034.49 cents. And then today is a big day. We get paid for both HOOW and NVDW. So let's hop real quick into that. HOOW, we ended up getting paid $26.36. And the reason why is because we got paid 85 cents a share for our 31 shares. Okay. So let's quickly add that into the sheet. So we got 26.36. All right. 26.36. NVDW as well. So as you can see here, we got paid $14.67. They paid us 47 cents a share, and we have 31 shares. So that's why we got that amount. And now let's update that. So that's 14.67. If we pull out our handy dandy calculator, we have 26.36 plus 14.67, and that's $41.03. And if we add that to this $196.66, we get $237.69. So we are looking amazing, guys, and I'm really excited. So now hopping into the dividend sheet. As always, I like to look at the market return and total return. We are currently pretty good. We have total return percentage of 14.73% for HOOW, 5.23% for WPAY, and 5.79% for NVDW. And then the market return, 10.59% for HOOW, 2.71% for WPAY, and 4.86% for NVDW. Now, something to keep in note, if you're new here, this doesn't update usually pre-market. It only updates when the market opens. So we need to update HOOW and NVDW. We're going to start with HOOW. So we got $87.75. And we are going to add, how much did we get paid again? $26.36. So 26 and 36. So that's $114.11. So 114.11 cents. Is that correct? That is. And then let's hop into NVDW, 14.3 or 0.67 plus 13.13, and we are at $27.80. So 27.80. Since I've been holding these positions, these are how much dividends I've been paid out. We can see we're at $237.69 for the month of October. We still have one more dividend payout, and that's for WPAY. So I will update that in the next portfolio update as well. I'm just going to repeat this for those who are new. These are the dividends that I received from sold positions. I do have a sold positions log. You can pause this here real quick to see which ones I've sold, but I'm not going to cover this. This is the amount that I've received so far this year for my dividend income. So I've received $271.86. Now let's hop into X. I have some different news and things that I wanted to share with you guys. First and foremost, this is from Richie B. If you've been following my channel for at least the last few videos, I've been really paying close attention to this guy's X account. He posts some great content, and he says, why I'm bullish on RoundHill, Part 4, ROC edition. Return of capital is something that is severely overlooked and misunderstood. I agree. RoundHill ETFs like HOW are structured to pay 100% ROC, and it's one of the most underrated advantages out there. When a fund pays ROC, you still receive the cash, but it's not taxed as income. Instead, it simply reduces your cost basis. Example, if you were to buy 1,000 shares of HOW at a 74 cost basis and receive $74 in dividends that year, and it's classified as 100% ROC, you'll owe $0 in taxes on those payments, since it's treated as a return of your own capital. Once your cost basis reaches zero, any future payouts are taxed as long-term capital gains, 15 to 20%, which is still lower than ordinary income rates. Now compare that to YieldMax's HOOY as an example. Those are typically 0% ROC, and their payouts are taxed as ordinary income. Basically the same as short-term capital gains rates, 22 to 37%. Great for showing income on paper if you need qualifying income for a loan, but more taxes you would have to pay. The real power of ROC: defers taxes now, pays later, and usually less. Keeps more money compounding in your account, still gives you the liquidity of real cash flow, makes the strategy ultra efficient for taxable accounts, and it's one of those rare setups where the yield is real, the structure is clean, and the tax treatment quietly favors patient holders. Final thoughts. YieldMax's structure wins for those who want immediate, fully taxable income. RoundHill's ROC wins for those who want tax-deferred, compounding efficiency. If you're not planning to take out any loans or need to show taxable income, RoundHill easily wins the tax advantage category. It's not even close. Fortune favors the bold, but preparation minimizes taxes. Still patent pending. Okay, so that obviously was not financial advice. I just wanted to share this just because I thought it was interesting and I learned quite a bit from reading his posts. What I'm most excited about, guys, is KYLD. Remember the other day I did that video and it said it's going to be released immediately? Well, Howard Chan has officially released a date, and that is 10/31/2025. So at the end of this month, we should expect Curve's high income ETF, KYLD, to release. So I'm super excited for this, and you know I will definitely be covering it in more depth later. Also, some good news, RoundHill Investments is going to be releasing this week GLDW and GDXW. Now, I know it says launching next week, but this was posted on October 24, 2025. So we are at October 28th, so it's already the week that it's supposed to be launching. I'm truly excited, and I can't wait for this one. I would be very interested in taking a look at the GLDW position and possibly looking into getting into that. Last, but definitely not least, RexShares Income Max Option Strategy ETF, ULTI, with an I, not a Y, is coming soon. And it says ULTI invests in 20 to 30 of the most volatile US stocks using a sophisticated option strategy aimed at producing weekly income. The strategy will actively adjust to market conditions, shifting its portfolio of holdings and options positions to manage risk and capitalize on opportunities. It's really exciting to see another competitor of ULTI coming out with something that is going to change the game. I'm definitely going to be paying close attention to this, and best believe once it launches, I will share more details with you guys regarding it. I did want to share something. So the previous video, I mentioned BLOX, and I talked about my concerns with BLOX as a whole, its management, and only because Jay Pestricelli from Tidal, who also manages YieldMax's funds, is involved in this project, is involved in this fund by Nicholas Wealth. And so here's David Nicholas, and he shares something that gave me a lot more peace of mind. And yeah, it's just something to be mindful of. So let's play it, and hopefully you guys can hear this.
Quite frequently, and I think the value that you get in a fund like this is you just got active management on it. Tidal's been fantastic, which is why I love partnering with them. Jay and his trading team. I mean, they watch our positions closely, and they alert, and we, between our team and titles team, we can be pretty quick on these changes.
So yeah, I hope you guys were able to hear all that. If not, that kind of sucks and I had to skip over this part. But this is an interview that was done 3 months ago about BLOX from Brad over at Income Architect. David Nicholas really stresses how he's managing or co-managing the fund with Jay over at Title Financial Group. But at the end of the day, he's paying close attention to it as well. He's selecting funds. They're pulling out funds according to what's working, what isn't, what positions are able to produce income, what positions are not. But also something interesting in this overall interview is he mentions how their goal is to aim for making more income than they actually pay out. That's really good to know because they're actually working on capital preservation and capital appreciation, which equates to NAV appreciation, okay? NAV preservation. So that's why if we take a look at BLOX's chart, you can kind of see that it's constantly moving up and to the right. Even with the more recent tariff news dip, we saw that it's still moving at a pretty good upward trend and it didn't get hit too harshly. But yeah, I hope that all clarified some things after my last video. I've been chatting with a lot of different people about BLOX, about how it's managed. I personally like David Nicholas's philosophy and mindset towards this. Jay is a little bit more of a character who I'm sure he's well versed in his industry, and by no means am I questioning his credibility or authority. It's just with the way YieldMax ETFs have been managed, it seems that they didn't really have the same care as they're doing with X funds from Nicholas Wealth. Thank you guys so much. If you haven't already and you're a new subscriber, make sure to hit that subscribe button. If you really enjoyed this video, please give it a thumbs up. That would help so much and mean the world to me. And most importantly, if you have any suggestions, feedback, or anything else, comment them down below. I would love to hear them. And without further ado, until next time, guys, peace.